My belief is, over the next 10 years, that the United States dollar will probably lose about 75% of its purchasing power. I say that because the on-balance sheet liabilities of the U.S. government are in excess of $30 trillion net. But more importantly, the off-balance sheet liabilities of the U.S. government, Social Security, Medicare, Medicaid, federal pensions, military pensions, exceed, according to the Congressional Budget Office, $100 trillion. So the U.S. federal government is $130 trillion behind the eight ball. That's before state and local governments. To put that into context, gross revenues for the U.S. government are $5 trillion a year. So the debt is, 26 times gross revenues before any expenditures? We had a circumstance like this before, although not as dramatic, in the decade of the 70s, and the U.S. dollar lost 75% of its purchasing power. My suspicion is that the way that we deal with all of these entitlement liabilities is that we honor the nominal obligations while we inflate away the net present value. If you take down the purchasing power of the US dollar by 75% without a real move in the gold price, you triple the gold price in dollar terms. And that's precisely what I think is going to happen. By the way, I take no particular pleasure in this. The set of circumstances that causes very strong gold rallies are usually very harmful to the rest of one's life and one's portfolio. And my life is quite good. I would prefer that I didn't have to have this kind of concern. But it's very difficult looking at the arithmetic around on and off balance sheet liabilities in the US and not be concerned about the maintenance of purchase power of the dollar. If you're a central banker, by the way, buying gold is a very hard thing to do emotionally, because gold calls into question the very premise of central banking. Traditionally, central bankers have preferred to own treasury securities issued by other central banks because it legitimizes central banking. But things changed, as you suggest. The United States decided to weaponize the dollar through the extraterritorial imposition of U.S. will in the SWIFT banking system, and then, of course, by, irrespective of your belief in U.S. foreign policy, by stealing $300 billion worth of Russian gold. I think that, in particular, China, given the size of the economy and the importance of exports to the Chinese economy, has no choice but to go to gold. They look at the U.S. government as one that they are in a period of increased conflict with, and they look at the predisposition of the U.S. government to weaponize the world's reserve currency. And they also look at the U.S. 10-year Treasury paying 4% in a currency where, from their point of view, the purchasing power is declining by 7.5%. And they say, now wait a minute, we're giving seigniorage to the U.S. government who doesn't like us, and we're losing 350 basis points of real yield a year. This is a bad deal politically, and it's a lousy deal arithmetically. Against that, you look at any other currency they can trade in. Just how many rubles would the Chinese like? The answer is not very many. They're going to go to the BRICS currencies? I mean, none of the underlying currencies behind the BRICS are convertible. Why would the Chinese do that? The truth is, now, when China gets rubles, what they do functionally is they turn them into dollars. They have no choice but to hold gold, because there isn't another asset class that is simultaneously an asset and a medium of exchange other than gold and the US dollar. And the US dollar has proven itself to be a less reliable store of value and an increasingly politically challenged medium of exchange. Tariffs are taxes. The idea that you put a 25% tariff, as an example, on Canadian goods coming to the U.S., and that doesn't flow through to the U.S. consumer. I mean, our president shouldn't be smoking whatever he smoked when he decided that tariffs somehow weren't taxes. That's just an insanity and an absurdity. But the rest of what Buffett said, one should be paying attention to. Too many people, when they look at the U.S. dollar, are glossing over some basic arithmetic. A lot of people, when they look at the stability of the U.S. dollar, they assume that the inflation rate that impacts them is the CPI. The CPI would tell you that the deterioration of the purchasing power of the U.S. dollar is 2.6% a year. I challenge you to find any American whose basket of goods and services is only going up by 2.6 a year. Take the period 2020 to 2025. Tell me what happened to grocery bills. Tell me what happened to health care and health insurance. Tell me what happened to rent. Tell me what happened to gasoline. And tell me that the U.S. inflation rate is 2.6% a year. Besides which, the CPI doesn't include tax. The most important component of a household budget in the United States is tax, and the so-called rate of inflation doesn't include tax. I ran an exercise on my own budget, not a slavish one, a back-of-the-envelope exercise, and the basket of goods and services that I consume, and I'm an old rich guy, I don't buy much, shows me that the purchasing power of my savings is deteriorating about 7.5% a year. Now think about the impact of that on the U.S. Treasury. I own a U.S. Treasury. If I did, a 10-year Treasury, I'm getting paid 4.5 in a currency where the purchasing power is declining by 7.5. That means if I loan my money to the U.S. government for 10 years, they solemnly swear after 10 years to give me back 60% of what I gave them. That's a good deal, right? If you believe that gold trades inversely to the confidence associated with savings instruments denominated in the world's reserve currency, obviously one answer is gold. Certainly the answer I've chosen. Over the last 60 years, betting against Buffett has been a really stupid bet. Putting it in perspective, over half of his assets now are cash. Mr. Buffett understands completely that holding cash at 4% generates a negative real yield. So there is a cost to him of having too much cash. He declined to answer publicly anything about the economy. But if you look at the portfolio distribution that Buffett's exhibited over 3 years, he's gone from 20% cash to 52 or 53% cash. I have a serious time believing that Mr. Buffett's analytical faculties are diminished enough that he can't find good companies. He's traditionally been very good at that. I think he's absolutely positively making a market call. Several months ago when you interviewed me, I think I said I didn't own gold myself because I thought it might go to 3,000. I said I owned it because I was afraid that it was going to go to 9,000. That's not a price projection. But the truth is that gold has, for a very long period of time, taken care of portfolios well when people were concerned about the maintenance of their purchasing power, particularly in reserve currencies like the US dollar. Anybody who isn't concerned about that right now, I think, is operating on questionable premises. It's very difficult for me to understand why somebody wouldn't own gold, in fact. If you're Rick Rule, the U.S. economy is in okay shape. Artificially low interest rates benefit guys like me. I have access to credit, which is subsidized, and I have the knowledge to learn how to use it. But there's a very, very thin veneer of people for whom the U.S. economy is working. People who don't have my skill sets, people who don't have access to credit, people who don't have a knowledge of how to use the credit. For those people, things are challenged. There's a wonderful joke in the little town that I live in. Yeah, the economy's generating a lot of jobs. I got to have 3 of them to live. There's some subcurrents under the U.S. economy which are problematic. The economy is working for some. It's not working for most. But the scary thing is, I think, the entitlement liabilities. Most Americans believe that the U.S. debt is $36 trillion or $30 trillion net. They forget the net present value of unfunded liabilities, which exceeds $100 trillion. There's a whole bunch of Americans who believe that Social Security and Medicare and Medicaid and all that is going to be for them. If it is going to be there for them, somehow we need to find $100 trillion, which is to say we need to find 3 times our GDP. Well, this is hugely interesting to me. Really since 1992, since the demise of the bond vigilantes, the Fed and the political forces have been able to manipulate interest rates lower. The fact that they are jawboning interest rates down and in fact moving the cost of funds down, the Fed funds rate down, while at the same time losing the long end of the curve. And what I think is the related fact that since 2022, both the interest rate, the long interest rate, and the gold price have gone up simultaneously, tells you that there is a change in the risk assessment around the long bond. The arithmetic is horrible. If I'm right, if the deterioration of the purchasing power of the US dollar really is 7.5%, and long bond investors are experiencing a 300 basis point negative real yield, then you're going to begin to see a decoupling of the interest rate that resembles that which we saw in the decade of the 1970s. We saw the prime rate at the beginning in 1970 at probably 4.75, and we saw the prime rate in 1980 at 18. It was an interesting circumstance. I don't understand how you service $100 trillion in politically sensitive entitlements. The way I think you do it is you honor the nominal valuation. In other words, some old geezer named Rick Rule, who gets $4,000 a month in Social Security or whatever they pay me, continues to get it. But they devalue the purchasing power so that $4,000 buys me $700 worth of goods and services. That's precisely what happened in the decade of the 1970s. The political forces would tell you that the whole problem in the decade of the 70s was the increase in the oil price. That was part of it. People forget that weren't there, that we fought 2 wars simultaneously. Vietnam, which we lost, and the war on poverty, which we lost. We had a guns and butter policy, and there was a whole bunch of politically unsustainable programs. The way we dealt with that in the decade of the 1970s was allowing the deterioration of the purchasing power of the US dollar. And that's the way we're going to deal with the $100 trillion net present value of structural entitlement debt now. I don't see any other way out. I mean, you can do two things. You can have an honest default. You can call up the bondholders and say, too bad, so sad, times are tough, screw you, strong letter to follow. And you can say to Medicare holders, goodbye. You can say to Social Security guys, yeah, you paid in your whole life, so what? There's nothing left. Or you can inflate away the net present value of the obligation and not index taxes to inflation, which is precisely, I think, the way out. If that occurs, if I'm right, with regards to inflation, as they say, you ain't seen nothing yet.